Welcome to our deep dive. Today, we're digging into something that's definitely stirred up some conversation. ARK invests really high price target for Tesla stock.
Yeah, if you all Tesla, you've probably seen ARK's numbers. They tend to stand out.
They really do. So we've been looking through the analyses, the summaries of ARK's research here, and our mission, basically, is to break down their thinking.
To really get under the hood of why they're so bullish.
Exactly. We want to pinpoint the core driver, like the biggest single reason behind this, well, pretty bold forecast for Tesla's value down the road.
And the interesting part, right from the start, is that according to ARK's view, it's not primarily about selling more electric cars.
Not at all, which might surprise some people. They see something else as potentially way more valuable. Okay, so let's kick off with those headline numbers from ARK, based on what we reviewed. Their average price target for Tesla in 2029, a staggering $2,600 per share.
Wow, and they have ranges too, right?
They do. A bullish case, potentially hitting $3,100. And even their more cautious, bearish scenario still lands at $2,000 a share.
So let's put that into perspective. The sources mentioned recent prices maybe in the $200 to $300 range, give or take.
Right.
Hitting $2,600.
Right.
That's suggesting, what, a potential 7, maybe 10 times increase from those levels?
It's huge.
A target like that really signals ARK sees Tesla as fundamentally something very different than just a car maker.
And that brings us right to the absolute core of it. The main finding from these sources, the thing that really defines ARK's whole position here.
Okay.
Their analysis suggests that a massive chunk, we're talking roughly 80% to maybe even 90% of Tesla's entire projected value by 2029 is expected to come from just one specific business line.
One area driving almost all the future value. Okay, I'm listening.
Yeah.
And that area is robotaxi.
Robotaxis. Autonomous driving taxi services.
Right. So what's really fascinating, and this is key, is that ARK isn't primarily basing this huge valuation on, say, how many Model Ys Tesla sells next year.
Or even their overall EV market share, necessarily.
Exactly. They're looking at Tesla and seeing, first and foremost, a future company built around self-driving mobility as a platform.
Okay, hold on. Robotaxis making up 80, maybe 90% of the value?
Yeah.
That's an enormous bet on one thing. What is it about these robotaxis that makes them that valuable in ARK's model?
Well, the absolute key difference, the thing that changes the game according to ARK, is profitability. Margins.
Okay.
They see robotaxis not as selling hardware, but as selling a software-based service, and potentially a very high margin service.
So different economics entirely.
Completely. Think about a regular taxi or, an Uber ride today. What's the biggest cost?
The driver?
The human driver, yeah. Take that cost out with autonomy, and suddenly your cost per ride or cost per mile can drop dramatically.
Right, and the sources we looked at really hammer this point home. They contrast the margins. Typical EV sales margins maybe somewhere in the, 15% to 25% range?
Yeah, something like that. Good margins for automotive generally.
But robotaxi service margins, ARK is projecting those could be like 80% or maybe even higher?
80% plus. That's software-like margins. It's a fundamental shift or a really dramatic change in the potential profit model for the whole company.
Okay, so super high margins. What about the scale?
That's the other part of the equation. You combine those high margins with potentially massive scale. ARK's projections talk about maybe 5 million robotaxis operating globally by 2030.
5 million.
And they estimate each one of those cars could potentially generate something like $30,000 a year in revenue.
Okay, wow. So you multiply that out.
We multiply that out, especially with those 80% plus margins. You can see how that revenue, and particularly profit, could potentially just dwarf the money made from actually selling the cars themselves.
And there's an efficiency angle too, right? Feeding into those margins. It's not just removing the driver.
Exactly. Robotaxis would also benefit from the lower operating costs of electric vehicles compared to gasoline cars. ARK estimates EVs cost about a third as much per mile for energy, maintenance, that kind of thing.
Right.
So ARK did this cost per mile analysis that's pretty interesting. They estimate robotaxi costs could potentially get down to like $0.25 to $0.40 per mile. 25
to 40 cents a mile. Compared to what for a traditional taxi?
Compared to maybe around $2 per mile for a traditional human-driven service.
Okay, so that's a huge cost advantage. That suggests they could potentially offer much lower prices too, really disrupting.
That's the implication, yeah. Serious disruptive pricing power in the whole transportation market if they can achieve those costs and scale it up.
Okay, so the potential looks enormous on paper. Huge market, incredible margins, big cost advantages. But that's the potential. The multi-trillion-dollar question is, can Tesla actually pull this off?
Right.
What makes ARK believe Tesla is the one to, not just compete, but actually lead this whole robo-taxi race?
Well, ARK's analysis points to a few key areas where they see Tesla having some pretty distinct advantages.
Okay.
First and foremost, they really emphasize Tesla's lead, or perceived lead, in the full self-driving technology itself, the FSD.
The software.
The software, exactly. ARK argues Tesla's ahead, mainly because of just the sheer volume of real-world driving data they've gathered.
From all the cars already on the road using FSD beta.
Precisely.
Yeah.
Millions of cars, billions of miles. That data is like gold for training and improving these AI systems. They see that as a massive moat.
Okay. Data advantage. What else?
Second, they talk about hardware integration. Tesla doesn't just buy off-the-shelf sensors and chips, right? They design their own cameras, their own custom silicon, like the Dojo supercomputer project.
Right, they build it all in-house, basically.
Yeah, and they integrate it tightly with the vehicle design right from the start. ARK sees this, creating this really strong synergy between the software and the hardware, optimized specifically for autonomy.
So they control more of the stack, unlike companies maybe patching together third-party bits.
That's the idea. And that leads to the third point. Vertical integration more broadly.
Meaning?
Meaning they control manufacturing, the software development, and they own the charging network, the superchargers.
Ah.
ARK believes this whole package deal allows Tesla to potentially iterate faster, scale quicker, and optimize the entire robotaxi service more effectively than competitors who might rely on partners for charging or manufacturing or core tech.
So it's less like just selling a product and more like building this whole ecosystem.
Exactly. It starts to look less like a traditional automaker and more like building and operating a whole platform economy. Kind of like an Uber or an Airbnb maybe, but with much deeper control over the actual physical assets and infrastructure.
Okay, so summing up ARK's view, it's this mix of, one, these potentially amazing market dynamics, huge size, high margins, and two, Tesla's specific advantages in FSD data, custom hardware, and that vertical integration. That's the foundation for their really bullish robotaxi case.
That's the core of it, yeah. So what does all this actually mean for you if you're, watching Tesla, maybe thinking about investing or just trying to understand where it might be going?
Right, the takeaway.
Well, the opportunity, if ARK is right, if this plays out, it's genuinely massive. We're talking about disrupting the global transportation market, which is worth trillions. Capturing a big slice of a future autonomous chunk of that market could create enormous value.
It's clearly a long-term vision they're buying into.
Oh, absolutely. The sources make it clear ARK's perspective is very much long-term. It's a bet on Tesla's vision, yes, but also critically on their ability to execute on some really, really difficult technology and scaling challenges.
And it's definitely not without risks. I mean, ARK models different scenarios, so they acknowledge risks, even if they lean optimistic.
For sure. The risks are substantial, and anyone looking at this space knows them well. Competition is fierce.
Right. It's not just other car companies. You've got big tech, specialized AV startup.
Exactly. Then there's regulation. Getting approval for widespread, truly driverless operation, that's a huge hurdle. It's complex, varies everywhere, cities, states, countries. You need safety validation, public trust.
It's not a simple switch you just flip on.
Not at all. And, maybe most importantly, the core FSD technology itself still needs to prove it's fully mature, incredibly reliable, demonstrably safe for mass commercial deployment without a driver ready to take over.
The sources mention things like initial limited rollouts, which kind of underscores that it's going to be gradual, right?
Yes, very likely phased and cautious, especially at first. It won't be 0 to 60 overnight.
So thinking about potential timelines, like the sources suggest, the short term, say the next year or so, robo-taxis probably won't move the needle much on the stock price. Maybe even some caution with those first small rollouts.
That seems reasonable, yeah. Initial challenges, limited scale. The medium term, maybe looking out 1 to 3 years, that's where you might start seeing a more positive impact if the service expands significantly, if the tech proves itself more widely.
But the big prize, the thing that could actually justify those huge $2,600, $3,000 price targets from ARK, that's really a longer-term bet.
Definitely. That's the 3+ year horizon, where the potential lies if the business scales massively and if Tesla really does manage to capture a dominant share of this emerging high-margin mobility market. It's a lot of ifs.
Okay, so wrapping this deep dive up, the clear central takeaway from looking at ARK Invest's analysis is this. Their super bullish forecast for Tesla. It's overwhelmingly fundamentally driven by the potential they see in the robotaxi business.
Yeah, they're not just valuing a car company anymore. They're valuing what they believe will become a high-margin, autonomous mobility platform.
So what, for you, the listener, is that this analysis really encourages, maybe even forces you to think about Tesla's future value very differently.
Right. It shifts the main focus, at least in AirK's view, away from just counting how many cars they sell each quarter.
Which is what Wall Street mostly focuses on now.
And toward the potential future value generated by autonomous miles driven as a service, bringing in that high-margin recurring revenue.
Yeah.
It's a completely different business model layered on top.
So here's a final thought to leave you with, building on that. Think about the broader implications here. If a company known primarily for making complex hardware, like cars, could potentially see the vast majority of its future value derived from a software and service layer, like robotaxis, what might that trend mean for other traditionally hardware-focused industries you follow?
That's a really interesting question. Where else could that software and service value unlock happen? Something to definitely mull over. It's been on, well, quite the roller coaster lately, hasn't it?
Exactly. Big swings up, then down. It can look pretty confusing if you're maybe newer to investing.
That volatility is key, based on what these sources say. It reacts strongly to news, to hype.
Right. So our mission here is to cut through that noise. We're looking only at what these specific sources tell us about the recent moves.
Trying to make sense of the catalysts, the drivers.
Distilling it down so you get a clearer picture of what's been happening and, importantly, why, according to these reports.
Isolating the signals from the noise, basically. What do these articles point to?
And it gets really interesting looking at the past month or so. Let's start with the positive stuff. May was, well, pretty remarkable for Tesla stock, wasn't it?
Yeah, the sources highlight a really big surge. One article mentioned shares climbing over 23% just in May.
23% in 1 month. That's huge, especially when you compare it to the broader market.
Right. The S&P 500 gained maybe 5.5% in the same time. So Tesla was way out ahead.
And this was after a rough start to the year, yeah.
Exactly. Sources remind us it was down, over 40% at one point. So May was a big recovery, though still down year to date back then, maybe 14%, according to one source.
Okay, so what drove that powerful May rally?
A couple of key things. One was Elon Musk's stated focus. He stepped back from some other things, said he'd allocate far more time to Tesla.
So the market liked hearing the CEO was doubling down on the core business.
Seems like it. Investors see his focus as a potential catalyst, maybe reigniting innovation or pushing key projects forward. Belief in his direct impact.
Got it. What else fueled that May optimism?
A huge one, maybe the main one, was the buzz around the robotaxi launch.
The robotaxi sounds very futuristic. What's the potential there, according to the material?
Well, the sources call it a potential game changer, a transformative opportunity. The idea is this new high-margin subscription revenue.
So not just selling cars, but earning recurring money from them.
Precisely. Like a high-margin software service, which investors love. And there were reports citing unnamed sources about a possible June 12th launch in Austin.
And didn't Musk add to that excitement?
Yeah, one source notes he said tests were a month ahead of schedule. That, plus the rumored date, really amplified the hype.
Okay, Musk refocusing, robo-taxi anticipation. Anything else boosting the stock in May?
Yes, one source points to the energy business megapacks, Powerwalls, calls it an underappreciated growth engine.
Energy storage. Is that becoming significant?
Looks like it. Sources mention triple-digit growth in deployments in 2024, continuing strong into Q1 2025, and crucially, gross profit from it increased significantly.
So more profitable, not just more sales.
That's the key takeaway. It's becoming a real earnings contributor, maybe even boosted by demand for AI infrastructure support.
Interesting link to AI. And finally, there was talk about Musk's pay package vote.
Right. The vote was June 13th. But reports before then showed strong shareholder support. Sources saw this as confidence in his leadership and future plans, adding maybe some stability.
Okay, so that's the positive story. CEO focus, robo-taxi hype, booming energy biz, shareholder confidence. But stocks go both ways. Let's talk valuation and risks.
Absolutely. Despite the optimism, the sources flag some big cautions. First off, the valuation itself.
What do they mean by high valuation?
Well, the PE ratio was noted as being over 200, meaning investors were paying over $200 for every $1 of recent profit. That's extremely high.
And that implies what? massive future growth expectation.
Yeah, exactly. You're not paying for today's profits. You're betting heavily on huge growth way down the road, especially from things like robotaxi that aren't major profit drivers yet.
So a lot of good news potentially already baked into the price.
That's one view presented, that the May rally might have already priced this news in, making it more of a hold than a buy after that run-up based just on that momentum.
Makes sense. Now, about that exciting robotaxi, any reality checks mentioned?
Yes, and this is crucial. Sources point to Musk himself, saying it likely won't be a major financial contributor until middle of next year, second half of next year.
Okay, so the big money isn't immediate.
Right. And the initial launch, if it happened June 12th, would start small, only a handful of cars. It takes time to scale. Valuing it now is tough, an art and science, sources say.
Vision's exciting, but profitability is further out. What other big risks? The sources mention Musk risk quite a bit.
Yeah, this is a major, unpredictable one. It's about his actions or statements outside Tesla impacting the stock. Specifically, a public conflict with former President Trump in early June.
How did that affect the stock, according to these sources?
The sources directly link Trump's criticism and talk of potentially stopping government contracts to a huge stock drop. Over 14% on June 5th, losing about $150 billion in market value.
Wow, $150 billion wiped out in a day due to a political spat. That really shows the risk.
It absolutely does. Shows how sensitive the stock is to his public persona and government relations. While it recovered partly, uncertainty remained. It's a clear, hard-to-predict risk.
A unique challenge for investors. Any other business headwinds mentioned?
Yes, slowing sales in some key European markets, Germany, Italy, UK, were reported for May.
And EV sales are still the core business, right?
They are. Sources say 72% of revenue. So even with future hype, a slowdown in core markets is a current challenge, adds complexity.
So putting it together, it's a stock trading on the future but facing present realities and, well, volatility.
That's the main takeaway. Very high volatility, big swings based on sentiment, future hopes, reality checks like the robotaxi timeline, and unique things like the Musk risk.
So based just on these sources, what does this mean if you're looking at Tesla?
Well, the sources outline this core tension. On one hand, exciting future potential. Robotaxi's high-margin promise, the booming energy business, Musk's focus.
A compelling story that justifies the high price for some.
It is, but balanced against big risks. The very high valuation, robotaxi profits being over a year away, the unpredictable Musk risk shown by that huge drop, and core business challenges like slowing EV sales in some places.
So betting on an amazing future, but navigating present, sometimes sudden risks.
Exactly. And the sources suggest different approaches based on this. Short term, high volatility means maybe watch from the sidelines, be conservative, too much event risk.
Wait and see.
That seems to be the caution for the short term. Medium term, maybe hold or buy on dips if robotaxi shows real progress and the profit picture gets clear. Give the vision time.
And long term.
For those seeing Tesla as a broader tech leader, AI, robotics, energy, steady investment might be the strategy, betting on that big vision. But even then, sources say monitor competition and regulation closely.
Sounds like understanding Tesla means grappling with huge potential and huge, unique risks. A real balancing act.
Precisely what these sources convey. Weighing tangible progress like energy against future visions like robotaxi, all while dealing with a high valuation, core market challenges, and that unpredictable Musk factor.
It really does. And it leaves you with a core question. How much is that incredible potential worth when it comes with such clear present risks and volatility, including those political headwinds? That's the tension to think about.
Okay, let's dive in. We're looking at Tesla, specifically that really volatile stretch between June 5th and June 13th, 2025.
Right.
You shared a bunch of material covering just that week, and it was quite something.
Yeah, definitely a roller coaster.
So our goal here, especially for you maybe just getting started with stocks, is to kind of sift through all that noise. We want to pull up the key things from those sources, what actually happened, why the stock swung so much, and what you can learn from it.
Absolutely. And what's fascinating looking at your sources for that window is the sheer volatility. I mean, just before this period, the stock had already dropped, what, like 17%?
Yeah, quite a fall.
Then, bang, between June 5th and 13th, it jumps back almost 14.6%. That tells you something big was going on. Major news driving things.
So what was driving it back up during that specific week? What did the sources point to?
The biggest thing really was the robotaxi buzz. It's positioned as, absolutely central to Tesla's future, kind of their next big act beyond just selling EVs.
Especially with regular EV sales slowing down, what the sources mentioned.
Exactly. So the robotaxi is seen as this potential game changer. And it wasn't just vague talk that your sources pinned down a launch date, June 22nd in Austin.
Okay, a specific date. That makes it feel more real.
It does. And maybe even a first driverless ride soon after, June 28th, maybe?
Yeah.
That kind of concrete timeline gets the market excited.
But the sources also gave details, right? It wasn't like suddenly robotaxis everywhere.
No, definitely not. The details are key. We're talking a small pilot, maybe 10, 20 Model Ys, and operating only in specific zones, these sort of geo-fenced areas.
Got it, like a digital playpen for the cars.
Yeah, pretty much. And crucially, with remote human oversight. So someone's watching, ready to step in. It's early days.
Okay, so still a lot riding on this for the valuation.
Oh, hugely. Analysts see a ton of Tesla's value tied up in this AI autonomous future. This pilot is step one.
Gotcha. And besides the robotaxi, there was the Elon Musk factor, too.
Always. It's unique how much his actions move the needle. Remember that big drop before this week? Sources linked it to that public spat he had with former President Trump around June 5th.
Right, that caused a huge single-day dip.
Yeah, like 14%. But then, during this week, June 12th, he issued an apology for some comments.
Ah, okay.
And the sources noted the stock ticked up, maybe 1%. Like, the market breathed a small sigh of relief. Less drama, maybe?
And the pay package vote on the 13th.
Right. That was looming. The expectation, highlighted in the materials, was strong shareholder approval for his huge $56 billion package.
Which was seen as a vote of confidence in him.
Exactly. Confidence in his leadership, his vision, including robo-taxes. So that expectation likely helped support the stock price, too, even though it was still down for the year overall. But year over year, it was way up, showing that long-term bet on the future.
Okay, so positive momentum from robotaxi hopes and Musk-related factors. But the sources definitely didn't paint a purely rosy picture. There were big risks causing swings, too.
Not at all. And it's crucial you see both sides. Let's go back to that big plunge before this week, the one linked to the Musk-Trump feud on June 5th, that 14% one-day drop.
Yeah, how does that happen? A CEO's comments tanking the stock.
It highlights what the sources call the Musk risk. Investors worry about distraction, maybe brand damage, just general unpredictability. It adds a layer of risk most companies just don't have.
Makes sense. And the robotaxi itself, despite the excitement, had uncertainties mentioned.
Oh, yeah. Musk himself is quoted being super paranoid about safety, which is good, but it means dates can slip. The Austin date already had, apparently.
And the small scale you mentioned, 10, 20 cars.
Right. That's tiny. Scaling up is a huge challenge. Analysts like Baird, Argus, they were quoted being cautious, warning about maybe over-optimistic expectations for how fast this ramps up. Plus, you always have safety and regulatory hurdles. NHTSA inquiries were mentioned.
And regulation actually hit the stock during this week, too, right? Something about California.
Yeah, June 12th. News about a federal rollback of California's EV mandate rules. It sounds technical, but it impacts Tesla's ability to sell those zero-emission credits, the ZECs.
ZECs, right. The credits other car makers buy from Tesla.
Exactly. It's a nice little profit stream for Tesla. So news suggesting that market might shrink, that hit the stock. Sources said it dipped about 2.2% on that news. Shows how regulations matter.
Okay, so robotaxi, potential but challenges. Musk factor cuts both ways, regulatory risks. What about just selling cars, the main business?
That's where the sources show real pressure. Slowing EV sales growth overall, more competition, Tesla sales declining in some key European markets. Revenue growth in 2024 was tiny, like 1%, and profit forecasts for 2025 were lowered. It underlines this key point. The current stock price isn't really based on current car sales performance.
It's based on the future hopes, the robotaxi, AI, all that.
Yeah, precisely. It's priced for a future that isn't here yet. The car business needs to work, but the valuation depends on belief in those big future bets. That's why news affecting those hopes, positive or negative, causes such big swings.
Okay, that really connects the dots. So wrapping this up for someone learning about investing, what's the main takeaway from this volatile week?
It's really this duality. Massive future potential robotaxi, AI driving huge expectations and the high valuation, that's one side.
And the other.
Very real present risks and volatility. Execution risk, like actually delivering the robotaxi scale.
Right.
Regulatory risks, like the ZEC thing. Competition, slowing core sales, and that unpredictable Musk risk.
So not your typical steady Eddie stock.
Definitely not. The price is super sensitive to future news and unexpected events. Understanding that is key if you're just starting out.
And the sources suggested different ways to think about it. Short versus long term.
Yeah, kind of. Short term, very volatile. Maybe watch from the sidelines unless you like big swings. Midterm, depends on robotaxi progress and sales picking up. Long term, it's all about believing in that huge future vision robotaxi, AI, and accepting the bumps along the way. But robotaxi success seemed critical for that long view.
So weigh the potential against those risks.
Exactly. The potential upside is huge. That's why the valuation is high. But the risks are significant and specific to Tesla, including its leadership.
So thinking about all that, especially how much of the price is tied to that promise of things like robotaxis, here's something for you to consider. How comfortable are you with the chance that making that future happen might take longer or hit more snags than the market expects right now? Worth mulling over as you keep learning.
Welcome to the Deep Dive. Today we're unpacking Tesla, TSLA. You've probably seen the headlines, but what was really going on between June 13th and 21st, 2025?
Yeah, it was an interesting period. The stock was mostly trading sideways, somewhere between $316 and $329 after a pretty good run-up.
Right. So our goal here is to cut through that noise, give you the key insights on Tesla without the overwhelm.
Exactly. Look at the big promises, potential problems, and what it all kind of means.
Okay, so this sideways action. Let's start with the positive stuff pushing Tesla forward. The big one seems to be the robotaxi. Finally happening.
It looks like it. The official launch of the robotaxi, or cybercab service, is set for Austin, Texas, June 22nd.
Austin, okay.
Starting with Model Ys for specific users, influencers first.
Yep.
And the first fully driverless trip, planned for June 28th, Elon Musk's birthday.
Ah, symbolic. From the factory to customers. That's a big statement after years of talk since 2019, really.
It is. It's seen as this signal flare for future growth, fulfilling that big AI and autonomy promise. They're planning LA, San Francisco next.
A whole new potential revenue stream, maybe bigger than car sales eventually. But it's not just robo-taxis, right? There's new vehicle tech, too.
Definitely. Lots of buzz about a lower-cost EV, the Model Q, that uses their gigacasting tech.
Right. Gigacasting. Making huge car parts in one piece to save time and money. Crucial for a cheaper EV.
Absolutely key. And on the battery front, big news, June 16th, a next-gen LFP battery.
LFP, okay. What's special about it?
Well, they're saying 30% faster charging, 20% longer life, and 15% cheaper to make.
Wow, those are significant jumps.
Expected for the 2026 Model 3 and Y, pushing range over 600 kilometers. There was even talk of a super aluminum ion battery 10-minute charge, 80-year life.
Okay, that sounds almost sci-fi, but interesting. So clearly moving beyond just cars. What else strategically? An AI center.
Yes, in Amsterdam. $50 million investment, hiring 200 people just to optimize the FSD neural networks. Shows how central AI is.
Doubling down on the AI.
And they're pushing it to being a living OS company. Think controlling your home lights, temperature via the Tesla app for energy savings.
An ecosystem play. Interesting. And supply chains.
Diversifying away from just China and Australia, looking at Chile, Canada.
Yeah.
Using AI to manage it all better. Plus, their first big energy storage facility broke ground in China.
Even with trade tensions, they're investing big in energy storage there. What about that Austin factory shutdown I read about? End of June.
Yeah, that's planned. Halting Cybertruck and Model Y for about a week.
Doesn't sound great for production.
It's strategic. For equipment checks, efficiency upgrades, they expect it to boost second-half output, especially for high-profit models like Cybertruck. Short-term pause, long-term gain.
Got it. Okay, so lots of exciting potential. But the stock was sideways, you said. So let's talk valuation and risks. Why wasn't it soaring?
Well, classic market psychology, partly. A bit of sell the news as the robotaxi launch got closer, some investors taking profits.
So volatility was expected?
Yeah, analysts called it a short-term trading zone. Like on June 20th, the stock popped 3% on the robotaxi invites, but actually closed down 1%. Still down 21% year-to-date back then.
Right. And regulation must be a hurdle for robotaxis.
Oh, absolutely. Huge hurdle. In Texas, some lawmakers were pushing to delay the launch, wanting more safety rules first.
Yeah. Political
pressure is real.
Makes sense. Success really hangs on getting past those approvals. What about ZEV credits? That sounded important.
ZEV credits, yeah. Zero-emission vehicle credits. States give them for selling EVs.
Yeah.
Tesla sells its extras to other automakers. It's been pretty significant income for them.
Like found money.
Pretty much. But California's regulation was withdrawn after Trump signed something related. That creates uncertainty.
How much uncertainty?
Well, those credits were apparently around 20% of Tesla's Q1 net income. So losing that, or even some of it, could definitely affect their profitability going forward.
And the technical picture, just reinforcing that sideways trend.
Yep. Stuck between roughly $316 and $329.
Yeah.
Technical resistance seen around $350, support near $290. It suggested more sideways movement, short-term at least.
So analysts were cautious.
Many were, yeah. Citing the general EV slowdown, plus these political and regulatory risks. Advising caution, maybe investing bit by bit.
Okay, let's pull this together. Tesla's in this really complex spot. Huge excitement around robotaxis, new batteries, AI.
The innovation engine is running full speed.
But at the same time, you've got real short-term risks.
Yeah.
Regulators, the ZEV credit changes, market volatility.
Exactly. It's that balance. The long-term story really depends on them successfully rolling out these AI services like robotaxi at scale and getting wide adoption of the new tech.
If they pull that off, the growth potential still looks strong mid to long term.
Potential is there, yes.
But for you listening, the takeaway is be aware of the immediate bumps, the volatility, the regulations watch, the ZEV credit impact. Watching how that robotaxi launch actually performs and how regulators react is key.
Crucial to watch.
So what does this mean for you? Tesla clearly isn't just cars, it's AI, energy, smart homes, a lot is going on. This deep dive shows that even with amazing innovation, real-world stuff like rules and market mood always matter. As you think about companies like Tesla, how do you balance that shiny tech potential against the messy realities of markets and politics? Definitely something to think about. Welcome to the deep dive. If you follow the markets, you've probably seen the wild ride Tesla stock, that's TSLA, has been on.
Oh, yeah. Especially that week in late June, right? Around the 20th to the 29th. Big surge, then, oops, a correction.
Exactly. And it was all tied to that robotaxi news. Huge hype then.
Well, reality checked in.
Left a lot of people, scratching their heads.
So today, we want to break that down for you. Cut through the noise, the hype versus what actually happened. Make it make sense, even if you're not deep into investing.
Right. What were the real drivers behind those moves?
Okay, so let's start with the positive stuff. It kicked off June 23rd. Tesla launched the robotaxi pilot in Austin.
Yeah, Austin, Texas. And the market reaction was, well, immediate. Enthusiastic is putting it mildly.
How much did it jump? Like 8 or 9%?
Just about, yeah. A huge surge. It showed how much excitement there is for this autonomous future. It wasn't just a new service. It felt like a glimpse of something big.
And the first riders seemed pretty impressed too, right? I saw reports saying better than expected. That initial positive feedback, even from a small pilot, really poured fuel on the fire. It built this strong narrative.
And analysts like Dan Ives at Wedbush got very bullish, calling it the start of the autonomous vehicle golden age.
A very bold statement. It really captured that feeling that maybe this was the next big thing. People piled in.
But that golden age feeling didn't last too long, did it? After June 24th, things reversed pretty quickly.
Yeah, the party kind of hit a snag. Reality bites, as they say.
So what happened? What cooled things off?
Well, a couple of things. First, reports surfaced about false driving videos circulating online. That cast some doubt on the whole thing.
So maybe the hype got ahead of the tech.
Possibly.
Definitely.
And then, maybe more importantly, news broke about a federal regulatory investigation into the service.
Ooh, okay. That sounds serious. Regulators getting involved always makes investors nervous, especially with new tech.
Definitely introduces uncertainty. And it wasn't just perception. There were real-world operational issues being reported from the pilot, too.
Like what kind of issues?
Things like signal violations, running stop signs, lane departures, and that phantom braking thing, sudden stops.
Right. Those sound like pretty significant safety concerns, not just minor glitches.
Exactly. You can't brush those off when you're talking about cars driving themselves on public roads. Safety has to be number one.
So while some analysts were still bullish long-term, others started sounding more cautious.
Right. You had analysts like at UBS, for example, saying maybe the good news, the robo-taxi potential, was already priced in.
Meaning a stock price already reflected that future success.
Yeah. So even if it works out eventually, the stock had already run up anticipating it. Then these new risks pop up. The safety issues, the investigation.
And this wasn't happening in a vacuum either. Tesla had other pressures, right? The stock was already down for the year.
Spot on. It was down about 20% year-to-date before this robo-taxi stuff, mostly because EV sales have been slowing down generally. More competition, maybe demand softening a bit.
And concerns about Q2 deliveries and profit margins, too.
Yeah, ongoing worries about shipping fewer cars and making less profit on each one. Those underlying issues make investors extra sensitive to any bad news.
So everyone's watching those upcoming Q2 delivery numbers and the earnings report at the end of July then.
Absolutely critical. They'll show the bigger picture beyond just the robo-taxi news.
So it's this constant tension, isn't it? Amazing innovation on one side, but then these real-world hurdles, safety, regulations, and the broader financial picture on the other.
That's the core dynamic, groundbreaking tech versus practical challenges. It means you, as an investor, need a careful approach. Don't just chase headlines.
Look at the actual developments, the financial results.
Exactly. Execution and market reality matter just as much as the vision.
So thinking strategically, what should people watch, say, short-term versus longer-term?
Okay, short-term, like the next couple weeks, watch for safety updates, regulatory news, maybe consider taking profits after a quick jump if risks appear.
Midterm, maybe 1 to 3 months.
Focus on those Q2 deliveries. Is EV demand picking up? That could signal re-entry points.
And long-term, 6 months plus.
Look at the bigger picture. AI strategy. Cybercab, maybe?
Yeah.
But always check the valuation. Is the price justified by the fundamentals like cash flow?
It really highlights the complexity. It's not just about cool tech.
Never is. Which leads to a final thought for you listening.
Yeah.
How do you personally balance that excitement, that allure of innovation, with the hard realities of market risk and financial performance when you think about investing? What weighs more heavily for you? Something to consider.